Somewhere in your house right now, there is an account you think of as your money, your 401k, your traditional IRA, the number you watched climb for 40 years. And on a Tuesday in the year you turn 73, the government is going to reach into that account, pull money out whether you need it or not, and hand you a tax bill on income you never asked to receive. Picture the man at the kitchen table, 73 years old, careful his whole life. He did everything the brochures told him to do. Max the 401k, defer the taxes, let it grow. Now he is holding a notice that says he must withdraw tens of thousands of dollars this year, count all of it as ordinary income, and pay the tax. He does not need the money. He was not planning to touch it. It does not matter. The withdrawal is mandatory, and the year it starts, it drags 3 other taxes into the room with it. He is not being punished for a mistake. He is being handed a bill that was always coming, on a date that was set decades ago, for a decision he made every single year without knowing he was making it. The deferral he was so proud of was never a gift. It was an appointment. Let me show you the date on that appointment and the one window where you can still shrink the bill before it detonates. Here's the thing almost nobody says out loud about a traditional IRA or 401k. It is not entirely your money. You have a silent partner, and it is the IRS. Every time you put $1 into that account over your career, you got a deduction. The government let you skip the tax that year. That felt like a win, and for a long time it was. But you did not erase that tax, you postponed it. The whole time your balance was climbing, so was the tax bill sitting inside it, unpaid. Tax-deferred was never tax-free. It was tax later, and later has a specific date on it. So when you look at a $700,000 traditional balance and think, that is all mine, it is not. Some slice of that account, maybe a fifth, maybe a quarter, belongs to your partner. You just have not settled up yet. And they get to decide when you settle, not you. You do not get to leave it in there forever, growing quietly, passing untouched to your kids. At some point, they come to collect on their calendar, and their calendar says 73. So let me make the machinery clean, because the details are where the damage hides. Starting the year you turn 73, the IRS requires you to pull a minimum amount out of your tax-deferred accounts every year. That is the required minimum distribution. The starting age used to be 70 and a half, then 72, and under the Secure 2.0 law, for anyone turning 73 between now and 2033, 73 is the line. The way they calculate it is simple. You take your account balance from the end of the prior year and divide it by a number from an IRS table. At 73, that number is 26.5. So a $500,000 balance divided by 26.5 is a required withdrawal of about $18,900 in year 1. All of it taxable as ordinary income. Now here's the part that turns a rule into a trap. That divisor shrinks every single year you age. 26.5 at 73, around 22 at 79, down near 12 by 90. A smaller divisor means a bigger required percentage, so the RMD is not a flat withdrawal. It starts around 4% of the account and climbs relentlessly as you age, forcing out more and more taxable income exactly when you have the least ability to plan around it. And they have teeth. Miss an RMD or take out too little, and the penalty is 25% of the amount you should have withdrawn, reduced to 10% if you catch it and fix it quickly. There is even a trap in the first one. Your very first RMD can be delayed to April of the following year, but if you do, you are forced to take 2 RMDs in the same tax year, stacking a double slug of income into one window. The rule looks like a courtesy. It is a tripwire. So that is the mechanism. Forced, growing, taxable, and penalized if you ignore it. But the withdrawal itself is not even the worst part. The worst part is what it sets off around it. Because a large RMD does not land in a quiet room. It lands on top of everything else on your tax return and triggers 3 separate hidden taxes at once. This is the detonation. The first is the Social Security tax torpedo. Most people do not realize your Social Security check can be taxed, and how much of it gets taxed depends on your other income. Push your income up with a big forced withdrawal, and suddenly up to 85% of your Social Security becomes taxable too. There is a zone where every extra dollar you pull from the IRA drags another 85 cents of Social Security into your taxable income behind it. Your effective tax rate on that withdrawal can spike past 40%, not because rates went up, but because $1 of RMD becomes $1.85 of taxable income once the torpedo fires. The second is IRMAA, the Medicare surcharge. Your Medicare Part B and Part D premiums are means tested based on your income from 2 years earlier. For 2026, the first surcharge tier starts at $109,000 of income for a single filer, and $218,000 for a married couple. And it is a cliff, not a ramp. Cross that line by a single dollar and you pay the full higher premium for the whole year, no easing in. A fat RMD can shove you over an IRMAA line you did not know was there, and the bill lands as a bigger Medicare premium 2 years later when you have forgotten why. The third is the one that breaks my heart, the widow's penalty. While you are both alive, you file jointly with wide brackets and high thresholds. Then one spouse dies and the survivor files single the next year. Same house, similar income, but now half the bracket room and half the IRMAA threshold. A couple comfortable in the 12% bracket can become a widow in the 22% bracket on nearly the same income. And the RMD does not shrink to match. The survivor inherits the full forced withdrawal, taxed at single filer rates in the middle of the hardest year of their life. 1 withdrawal, 3 explosions. And the fuse was lit back in your 60s. Let me put real numbers on it, because detonates is easy to say and hard to feel. Take Gary. He retires at 63 with $900,000 in a traditional 401k and a pension plus Social Security already covering his bills. He does not need to touch the 401k, so he does the thing that feels responsible and leaves it alone. For 10 years it keeps compounding, and by 73, that $900,000 has grown to roughly $1.5 million. Then the first RMD hits. $1.5 million divided by 26.5 is about $56,000, forced out, taxable, in a single year on top of his pension and his Social Security. That $56,000 pushes 85% of his Social Security into taxable income, launches him over an IRMAA line, and lands him in a bracket he has not seen since he was working full-time. He did nothing wrong. Doing nothing was the wrong thing. Now, rewind. Same Gary, same 900,000, but this time he uses the gap years, 63 to 73, on purpose. In those low-income years, before RMDs and before the torpedo, he moves money out of the traditional account into a Roth, filling the low brackets each year while they are cheap. He pays some tax now, willingly, at 12 and 22%, instead of getting ambushed at 40 later. By 73, his traditional balance is a fraction of what it would have been, so the forced RMD is small and manageable. The money he converted now sits in the Roth, growing tax-free, with no RMD on it ever, and it passes to his wife and kids without the silent partner attached. Same man, same starting balance. One version gets detonated at 73, the other quietly defused the bomb 10 years early, one low bracket year at a time. The gap between those two retirements over a lifetime of taxes and surcharges and a surviving spouse is not a rounding error. It is 6 figures. Same account, 2 different endings. So why does almost everybody take door number 1? Why do smart, careful people walk straight into this? Because the gap years do not feel like a deadline. They feel like the reward. You just retired. You finally stopped saving. The traditional account is fat and happy, the market is doing the work, and the last thing you want to do is voluntarily pull money out and hand the IRS a check you do not owe yet. Every instinct you built over 40 years of disciplined deferring says the same thing. Leave it alone. Let it grow. And that instinct, exactly right for 4 decades, becomes the single most expensive mistake of your retirement in the 10 years before 73. Nobody sends you a warning either. There is no letter at 63 that says, "This is your window, it closes at 73, act now." The RMD notice only shows up when it is too late to do anything but comply. The tax code does not knock during the years you could still fix it. It waits, politely, until the fix is off the table, then presents the bill. Now, there is one honest objection, and you may be thinking it. Why pay tax now when I could keep deferring? Fair. The answer is that you are not avoiding the tax. You are never going to. The silent partner always gets paid. You are choosing the rate. Pay on your terms in a low-income year at a bracket you control on a smaller balance. Or let it compound until 73 and pay on the government's terms at a rate the torpedo and the cliffs decide for you on the biggest balance you will ever have. Same tax, wildly different price. The only thing you control is when you settle up, and that expires at 73. So here's how you diffuse it, plain and in order. 1. Add up every tax-deferred dollar you have, traditional IRA, old 401ks, everything with traditional on it. That combined number is the balance the IRS will force out on its schedule. Write it down. That is the size of the bomb. 2. Count your gap years. However many years sit between the day your income drops in retirement and the year you turn 73, that is your entire window. For a lot of people, it is the early 60s through 72, the lowest taxed years they will ever have again. Those years are the only room you get. 3. In those low years, deliberately fill up the cheap brackets. Convert a measured slice of the traditional account into a Roth each year, taking just enough to top off the 12 or 22% bracket without spilling into the next one. And keep one eye on that IRMAA line so a conversion does not push you over it. You are moving money from the account the IRS controls into the account it can never touch again. 4. Protect the survivor first. If there are two of you, doing this while you are both alive and filing jointly is worth far more than doing it after, because the widow's penalty is real and it is brutal. Shrinking the traditional balance now is a gift to whichever one of you is left filing single. That is the whole shield. Know the balance, use the gap years, convert into the low brackets on purpose, and settle with the silent partner on your terms before 73 settles for you. If nobody has ever told you that your traditional account has a silent partner and a deadline, do me a favor, hit that like button and subscribe so the next person in their gap years gets this while the window is still open, instead of finding out at 73. That is the whole reason Walter does this. And here is your one job tonight. Do not convert anything yet. Do not call anybody. Just find your traditional IRA and 401k balances, add them together, and divide by 26. The figure you get is roughly the withdrawal the government will force out the year you turn 73, on top of your Social Security and your pension, taxed as ordinary income. Most people have never once seen that number. Seeing it is where the whole strategy starts. Now, every figure I gave you tonight depends on your balance, your brackets, your state, and your health, so this is the map, not your personal turn-by-turn. And a good tax professional should run your actual numbers before you convert a dollar. But the shape of it does not change. The deferral was an appointment. The gap years are the only window. And that window is closing quietly right now on a schedule you did not set and cannot stop. So the only question left is whether you settle the bill on your terms or wait for it to detonate on theirs.